RBI has been cutting interest rates, but given now that inflation is again picking up, it will be somewhere between say 4 to 5%. Government has to really do a fine job of managing the fiscal deficit as well as growth. And things would have been very, very easy has the Iran conflict would not have been there. But given that we are in that situation, it will be a tough situation. These estimates can come off if the war situation continues, but generally the mid-cap earning growth for next 2-3 years looks very, very positive. Government intent is very much clear that they want to increase the manufacturing in India. IT is one area where we have already seen a very sharp correction in the IT space. Due to the AI. Currently the environment is uncertain given the capabilities of AI model which are there currently. So I know that market over say last even 1.5-2 years has been patchy and these are the times where investor becomes really anxious and they have not kind of made return over say last say 1.5 years. But we have to again look this in the context that before this last 1.5 year of say time correction, I would say, we had a very, very good return period of 3 years. And that is how the market will move. Market will never move in a linear fashion. It will move, it will have its own ups and downs. And if one is slightly long-term oriented, if one has some bit of patience, then these cycles or these downturns actually provide an opportunity to invest, and whenever anybody when invest in this period, they eventually make a very good return. And if you look at whichever period which you look at, so the biggest was the GFC which happened in 2008-9, 2007-8. Anybody which have invested when the market was corrected very, very sharply around 50%, they would have made a very, very fantastic return. Second was the COVID period. Whenever there was a very, very sharp correction in the market, and anybody which would have invested during that period of time would have made a fantastic return. But those are the period when there is a very, very sharp correction. So you know that there is a very sharp correction. But in between also there has been a various period when market correct or doesn't move by for a period of 1.5 year, 2 years. But at the same time, there has been underlying companies which has been growing at a certain pace, and which makes the valuation reasonably attractive. And that is where again these are the times which provides the opportunity for us as an investor. So that is where we sincerely believe that there is always an opportunity in the adversity. And current last 1.5 year has been a time which has been not so favorable for us. Even currently, if we look at the Iran crisis has really created an adverse movement for India as a country. And again, this would be again a time where we should be actually looking positively from the investment perspective. This can again be one of those periods which can create an opportunity to make a longer term return for us. So that is one key message I wanted to start. If we look at India as a country, let's look at post-COVID period only. We have been doing very, very well effectively. Despite whatever people say, as a country, our GDP, nominal GDP growth has been somewhere around 10%, 10.5%, which has been a reasonably good growth for a country like us. Our real GDP growth has been somewhere around 7%. We even in each of the last 4 years, we have posted a real GDP growth which is 7% plus. This is a very, very healthy growth, and we are one of the fastest growing large economies. There could be some small country which may be growing faster, but if you look at the top 10, 15 large economies, we are one of the fastest growing economy. And this has come despite the period of fiscal consolidation. So India has been, as a country, we have been trying to curtail our fiscal deficit. So fiscal deficit was 5.6% in FY24. And we have reduced it by 130 basis point target. If we take the FY27 also, then we are trying to reduce it by 130 basis point. Has this curtailment or fiscal discipline not been there, our growth easily could have been 50 to 100 basis point higher. So we have been growing at a very, very good pace and still maintaining a very, very good fiscal discipline. From here onwards also, there would be some fiscal discipline which will be there. But on a per year basis, the amount is coming down. So if we look at from 5.6 to 4.8 was very, very large. But now from 4.8, we are now coming down to 4.4 and 4.3. So the incremental reduction in the fiscal deficit is coming down, and that is something which is very positive. So if we look at FY27, if this Iran conflict would not have been there, we would have easily grown at somewhere around 7.5% again. Because of the Iran conflict, RBI estimate is 6.9%. We believe it could be even 20-25 basis points lower than that. It could be 6.7%. This is again based on assumption that this is again slightly remain open. We don't really know when the war will end and what would be the average oil prices for India as a country for the full financial year. And these are important variables to keep in mind. But despite that thing, the worst case situation could be say 6.5% GDP growth. We still would be a very, very strong growth for a country like India. And still our nominal GDP growth should be still around 10% plus. So that this is a very good situation from the macro perspective. And if the war situation say ends early, say if the war gets resolved say in next 1.5 months, then there is a upside potential to these numbers. So we as a country are in a reasonably good situation from the macro perspective. Inflation, people may say that inflation can be a worry. Definitely it can be a worry, but we are coming from a very, very low base. So last year the inflation was less than 1% for a very good part of the year. Now it will increase. Already it has increased to around 3.5-4%. There would be there is a possibility that the petrol pump prices can increase. Quantum is not known. Speculation is somewhere around 5 rupees or 10 rupees. Again, it will lead to a spike in inflation. But we still would be in a range would be somewhere between 4 to 5% based on the current estimate. And this is a very, very comfortable zone for a country like India. RBI comfort zone is 4% plus minus 2%. So as long as it remains below 6%, we are in a very, very comfortable zone as far as the inflation is concerned. So GDP growth is in a good situation. Inflation is in a good situation, and this is at a time when India as a country is getting impacted because of the Iran conflict. So despite all those adversity, we are still doing reasonably well given the situation. So that is something which is there. In terms of interest rates, RBI has been cutting interest rates, but given now that inflation is again picking up, it will be somewhere between say 4 to 5%. There will not be, our assumption is that there will not be any further interest rate cut. We will probably maintain the interest rates which is currently there. So from the macro perspective, on GDP growth, inflation, we are reasonably fine. Coming to another thing is which is the capex. The central government capex, which has actually increased very, very sharply post-COVID. So if you look at say from FY21-22 to FY25, we have seen a very, very sharp growth in the central government capex. Having seen such a sharp growth, now we have reached a situation where the incremental growth on the central capex would be in line with our nominal GDP growth. So it would be somewhere around 10 to 11%. Our nominal GDP growth is expected to be around 10 to 11%. Our central government capex would be around 10 to 11%. There would be obviously some pockets where the growth would be higher, and I will touch upon those. But generally, at a overall level, the central government capex would be around 10 to 11%. However, the private capex, which has been remaining almost subdued for almost a good part of the last 10 years, now we have started to see early sign of revival. And we are still in a very, very early cycle as far as the corporate capex is concerned. So that is one thing which can actually pick up. So if you look at the last 2-3 years, it was the central government capex which was driving the overall capex growth. Now central government capex will grow at a range which should be say 10% or 11%. But the private capex growth could be significantly higher, and hence we will end up at a growth rate which still would be a good from the capex perspective. So this is again would be a good situation to be in from next again 3 to 4 years perspective. One area of worry for the near term is the tax collection. So if you look at say so we have been growing our tax collection has been growing at a very good pace, around 30% in both FY23 and 24. But in FY26 it has come down to 7%. At least that is the budget estimate. This is from here. If you look at the next year estimate, it has been around 8%. We were expecting that this were the conservative number, and we expected that the growth should be higher than 8%. But given the situation which is there in terms of conflict, this number may actually be more realistic now. It looks like more realistic number. So we may not see any positive surprise from that. So this is something which is slightly subdued in our opinion. And government has to manage the fiscal math somehow because of the slightly lower growth on the tax collection part. The government has budgeted around $80 billion or 80,000 crore of divestment income. Again, this is one area where we believe that this number actually can be lower than what the government has budgeted. So these are a couple of things where because of these things are not as easy or as rosy as we are saying. Again, this is just from the next 12 months perspective. Things can, government has to really do a fine job of managing the fiscal deficit as well as growth. And things would have been very, very easy as the Iran conflict would not have been there. But given that we are in that situation, it will be a tough situation. And again, everything essentially boils down to when the war will end. If it ends in say next 1 month, we don't have to really worry about these things. But if it gets elongated to say 3 months, 4 months, then these are the things which will become challenging from the central government, and it will also become challenging from the corporate earnings perspective also. Second area of worry because of this Iran conflict is one is that we are one of the largest importer of oil, so this is something which is very, very well known. But another area which is slightly not as well known is that almost 30% or 33% of our remittance from the Middle East. And if they are not in a situation where they are actually facing all this conflict, that number may come down. So this will again adversely impact the balance of payment situation for India. So again, these are 2 or 3 areas which have come under pressure because of the conflict, and we need to keep mindful of these, and we need to see how the situation is evolving. So these are the 2-3 things which we need to keep in mind. So again, there are some near-term headwind, near-term pressure because of the conflict situation. But again, the moment we look at longer term, 7% plus kind of real GDP growth, 10 to 11% kind of nominal GDP growth is something India can do reasonably well for next 4 to 5 years, and that would be a very, very healthy number. So we are reasonably positive. Obviously, one immediate next 3 months, 6 months would be a challenging period. We have done a lot of those things, like we have entered into a lot of these trade deals, etc. Near term, there will not be any benefit. The moment you look at from 3 years perspective, 5 years perspective, some of these will start to show in numbers also. So again, these will add to our growth in the coming years. So this is essentially what the macro situation was. Now coming to the equity market. From the equity market perspective, there are 2 very important variables we always keep in mind. One is the earnings growth, and second is the valuation. If you look at the earnings growth, if you look at the last 2 decades, if you look at the decades between FY0 and FY10, then our Nifty earnings growth was around 12%, 12.7%. Then we had another 10 years where the earnings growth was very, very subdued. We have grown at only at around 6.8% CAGR. But post-COVID, we started to show a very healthy growth. First 3-4 years, we have actually shown a very, very good growth. But again, that growth was kind of derailed in FY25. So FY25 was 1 year which actually saw a flattish kind of growth on the Nifty side. And FY26, our earlier expectation was around 6 to 7% growth, but that growth number has come down by around 1 to 2%, mainly because this conflict started in Feb, and some of these companies actually faced some problem in terms of supply of raw materials, etc., which will erode around 1 to 2% of growth from the Nifty companies at overall. So now our expectation is that FY26 growth would be around 4.5%. However, if the situation like this war situation gets over, then FY27 growth would be around 17.5%. So again, we can look at a very good earnings growth for the Nifty companies in FY27. If the war situation doesn't get over or this war get elongated, then this can again come back to around 10 or 11%. So this is again one big variable which is there currently, and we need to keep monitoring the situation, how it will play out. And that is where, if you see even the market also, there was a very sharp correction in the market in the month of March when this war started, and people thought it will going to last very long. But the moment there was a diplomatic situation and there was looks like that there could be some peace deal which can be signed between Iran and US, market again rebounded very sharply. Again, last 1 week, 10 days, the situation has again reversed a bit, and then we need to see how it is going to play out. So again, market will be volatile depending upon how this situation play out, because it will going to have an impact on the corporate earnings. But again, the moment we look at slightly longer term picture, this is only I am talking about FY27. If if we want to look at the next 3 or 5 years, we can easily grow at a rate which is somewhere between 13 to 15% from the Nifty companies. So earnings growth again can be significantly decent for the Indian market, and that will essentially get captured in the return. And again, we look at I'll come to that. Again, we look at in the context of valuation. The valuation, which if you look at last 10-year average, the Nifty valuation was somewhere around 20-21x. Currently, the valuation is 18x. So it is around 10% lower than the last 10-year average. So the valuation is very comfortable. So even if there is some disruption in the market in terms of earnings, the valuation comfort at least is there in case of Nifty companies, which is there. Second comfort which is there is that in FY25 particularly, and some part of FY26, what happened that whatever was the consensus estimate which used to be there at the beginning of the year, as the year was progressing, there was downgrade in the earnings estimates. But that cycle is also coming off. So if you look at, say, Q4 of FY24, we had around 3 to 4% downgrades in the earnings. That is now in last quarter, that is Q3 of FY26, that downgrades has come down to only 1%, 1 to 2%. So the downgrade cycle has actually again come off very substantially, and now the estimates looks more realistic than what it used to be the case, say, about 1 year, 1.5 years back. So this downgrade cycle, which used to be an issue for us, that is also coming towards the more realistic estimates for the Nifty as well as some of this mid and small cap space is concerned. Again, this is just that crude is definitely have a big impact on the market because it is inversely correlated. So that is something which is what is being reflected in this particular chart. Coming to the valuation of mid and small cap, again, mid and small cap still looks expensive compared to their history. If we look at mid cap, currently it is trading somewhere around half standard deviation above its historical average. But again, we need to look at again in the context of their earnings growth. There was a very earnings growth in FY26 has come off, but now again for FY27, the earnings growth for Nifty was around 17%. For the mid cap, it is around 25%. Obviously, there is a issue which can happen. These estimates can come off if the war situation continues. But generally, the mid cap earning growth for next 2-3 years looks very positive, and the growth in the mid cap and small cap would be significantly higher compared to the large cap. And that is where, though the valuation looks slightly more expensive, the earnings growth is also significantly superior. And that is which gives us some comfort. Obviously, this is at an overall level. We have to be selective. We have to select individual companies where which makes sense to us given the earnings growth of those particular companies. But though valuation are high on the mid and small cap side, given the earnings growth, they may not necessarily come off. We will definitely like to buy those companies at a lower valuation, but they may not necessarily come off. So we have to live with this particular situation. So this is essentially on the overall market. Coming to key sectors, from the next 1 year's perspective, some of the sectors which we like, one is the financial services. So generally, if you look at the banks, one thing which we really are positive on the banking side is that last year the credit growth came off very, very sharply. So it came below 10%. This year we have already seen that credit growth picking up. We are closer to around 13.5, 14%. And for the full year, our assumption is that the credit growth would be somewhere around 14 to 15%. And even if you extrapolate to next 3 to 4 years, we believe that credit growth can easily sustain somewhere between 13 to 15% for next 3-4 years. So the credit growth is something which came off in FY26, again is picking up. Second thing is the asset quality is something which is still very, very good. So there is no concern on the asset quality. So if you look at a previous banking cycle, though earnings growth was pre-provision profit was growing at a reasonable pace, but credit cost was actually eating away large part of the profit in the previous cycle. At least for next 2-3 years perspective, that doesn't seem to be the case at this point of time. Except for small pockets like microfinance, etc., most of the entire segment within the banking and the NBFC space looks very, very good from the credit perspective. In fact, PSU has been banks has been showing the write backs for last 1.5 years, and that may again continue for next maybe another 6 to 12 months. So so credit growth is credit quality is not an issue. So you have a very good steady growth and no issue on the credit quality. And secondly, the valuation of some of the large private banks has corrected very, very sharply. So from again, risk rewards looks very, very attractive for the banking sector. Within the banks also, there is another segment which is the non-lending segment. Again, we are very, very positive on that particular space. It is to some extent, some of these are links to market movement, etc. There is a slightly higher volatility in some of these segments. But again, the moment we take a slightly longer term view, 3 to 5 years perspective, these are something areas which can grow at a rate which is substantially higher than the banking industry. So they can easily grow at a rate which is 15 to 20%, where banking sector will probably grow at somewhere around 14 to 15%. So the growth profile of those companies would be significantly higher in the non-lending space, and hence they are again looking very, very attractive, and there is a long runway of growth in some of those segments. Second is capital goods. Again, there was last year was slightly subdued year for the capital goods, but we have already started to see some sign of pickup. Central government is growing at 10%, which already have stated, but we are seeing some early sign of pickup on the private space. And within the capital goods also, there are certain areas where we are far more positive. I'll touch upon those segment a bit later. Then third area where we are very positive is on the consumption, which is the more on the discretionary side, not on the FMCG side. So generally we have seen over last couple of years, firstly government has done a personal income tax rate cut. Then in October, November they did the GST rate cut. Then whenever there has been a state election, there has been a lot of social scheme which has been announced by various government or political parties. And lastly, so all these three will definitely add up to a reasonably large amount. And lastly, next year we will have a pay commission revision. We don't know the quantum, but historical trend always has suggested that whenever there is a pay commission hike, initial 1-2 years see a reasonable growth in the consumption. And that is where, if you look at all of these put together, for next FY27 perspective, this space looks good, and even from next 2 to 3 year perspective, this space looks good to us. Metals is something which is more of a near-term call. Metal prices are moving up, both And we are positive both on the ferrous and non-ferrous side. So we are positive on the steel, and we are also positive on aluminum and some of these segments also. But these are more of a tactical ideas. We are not saying that this is a space to buy for next 3 years, 5 years. This is a more of a FY27 call. But at this point of time, we are positive on the metal space. Consumer staples, generally from the longer term perspective, we are negative. But from next, again, 6 months, 12 months perspective, we are positive. Firstly, all the social scheme which government has rolled out will act as a positive driver. Second thing is the base is very low for these companies. So last 1.5 years has been low growth for this particular space. So growth is favorable. However, at the same time, the valuation are still relatively rich. So we are very, very selective on the consumer staple space, but we believe as a sector it will do reasonably well, and it will do better than what it has done in say last 1 or 1.5 years. Third area is auto, where we were very reasonably positive on the auto space. Again, largely a discretionary consumption space, and GST cut was a very large beneficiary for this particular space. However, in the near term, the headwind would be in terms of margin because of the commodity price increase. Their margin will come under pressure, and some of these companies are actually passing on part of the price increase, which can dent demand in the near term. So again, we have to be selective on the autos, and we have to really see how these commodity prices are shaping up. But so we have to balance out on the auto space, but generally we are positive on the auto space. Healthcare is one area where on the US pharma side we are not so positive. That is something we where it last 1.5 years has been subdued, and it may continue for even next 1 to 2 years. So as far as the US pharma is, some companies which are exposed to the export to US or European countries, we are not as positive. However, then there is other part which is the diagnostics as well as hospitals. There we are selectively positive. We have to look at individual companies in those spaces. Some companies are reasonably positioned, some companies are not so reasonably positioned. Again, the issue is the valuation. From the demand perspective, we are reasonably positive on the entire space, but valuation of some of these hospitals or diagnostics are not very, very conducive, and hence we need to be selective over there. IT is one area where we have already seen a very sharp correction in the IT space due to the AI, and it looks like a good time to put the money. But our view is that we are still, the overall environment has become very, very uncertain. And just to again give you a perspective, currently the environment is uncertain given the capabilities of AI model which are there currently. The capability of these AI model is also increasing exponentially. And that is where, based on today, we have a concern that there could be a deflation in the IT services companies today. Companies claim 5% deflation. Our estimate could be somewhere between 10 to 20% deflation. But this is based on the current capabilities of the models which are there. If the capability of some of these companies actually expand, then the deflation number can be higher. So given the penetration level, there is a very, very long runway of growth, and we have already seen this playing out in the US market, and this is something which will happen in India also over next 10 years, 15 years. So this is again one area where we are very, very positive. Second is the manufacturing and the infrastructure and capital goods. Firstly, India, government intent is very much clear that they want to increase the manufacturing in India. There, the big investments early has been on the electronic manufacturing. We started with just the assembly of the product. Now, over the last 1.5 years, we are going into the component manufacturing. So, in case of mobile phone, display assembly, camera assembly, this will now get manufactured in India. In case of say AC, we used to import 100% of AC, almost or 19% plus of AC from China. Now the situation is reversed. Almost 90% of the AC gets assembled in India. We manufacture a lot of component, but compressor is still largely imported from China. Government has come up with a scheme. We are putting up a capacity. Again, those will get manufactured in India. So initially, it was started with just the assembly work, but now we are getting into the component manufacturing, and that is where this is again one area which will continue to drive growth. Then electronics manufacturing is just a start. Government is now trying to get into the semiconductor part. Government, because of this energy crisis which we are currently facing, government is now trying to put a large part or increase our capacity for coal gasification. This is something which has come up in last couple of days only. That again would be another avenue for manufacturing in India. So there are a lot of opportunity, and we are under indexed in terms of manufacturing. The manufacturing as a percentage of GDP is still very, very low. So there is a long runway for growth, and this is something which will continue to be a growth driver for the overall market. Then on the infrastructure and capital goods side, though we are positive, but there are 2 or 3 areas which looks very, very interesting to us. One is the defense. Again, India has not spent enough on the defense side. We have underspent on the defense. And if we look at the current geopolitical situation which has been playing out over the last 2 to 3 years, government has realized that they need to invest a bit more on the defense. We are again not a country where we will suddenly really invest very, very hefty pace. But if you look at even the current year budget, overall capex growth was around 11% in line with the nominal GDP growth. But the defense capex was around 17-18%. So defense growth would be significantly higher than the overall capex growth for the central government. And this is based on only the domestic requirement. We are still at a very, very early stage, but export can become a good opportunity for next, again, 3 to 5 years perspective, not from next 12 months perspective. So again, defense is one area which again where we see a good visibility from next 3 to 5 years perspective, not just 1 year perspective. Another area which looks really good is the power sector. If you look at the power demand, last 10-15 year average, our power demand growth has been around 5.5%. But going forward, there has been few factors because of which the power demand growth could be 100 to 150 basis points higher than what the 10-15 years average has been. First is availability of electricity. It was that has now increased tremendously over last 5 years or so. Second is under penetration of appliances or consumer durables. Specifically the AC. AC is one of the largest contributor to the average household. Whichever household like us who have AC, this is the largest contributor to the electricity bill, because that is the largest consumer of electricity. Currently, penetration level of ACs is around 14 or 15%. So there is a long runway of growth. And given that India is a tropical country, we definitely see a scope where the penetration level will increase. It will be a seasonal product. There would be 1 year when the monsoon is good, this industry may not do well. Then there would be another year when the heat wave is high, monsoon is not so good, and they may do well. So it will remain a seasonal product, or seasonality will affect the industry demand from 1 year to another year perspective. But the moment you look at from next 5 years perspective, there would be a reasonably good growth for this particular segment. This will essentially drive the consumption growth which is there, which I will come, but it will also drive the additional growth for the electricity. Third area which I already talked about, that manufacturing is still India is under indexed or under investment into manufacturing. As the manufacturing is increasing, our electricity consumption will increase. Then the fourth is the newer area like data center, electric vehicle. At this point of time, they are very, very small part of India, but we have already seen in case of US, US is setting up somewhere around 70 gigawatt of data center capacities. So it is becoming a reasonable part of their overall growth. Even in case of India, currently we are around 1.5-2 gigawatt of data center, but that is expected to increase to around 10 gigawatt in next 5-7 years. This jump alone will be add to around 20-30 basis point of extra demand on the electricity side. So again, some of these areas will extra contribute to extra growth. So overall power growth will significantly higher than what we have seen historically. It will lead to a significant capacity addition on the generation side. Also, on the transmission and distribution network side, we have underinvested, and that is where there would be a very good growth for these companies, again from next, not just from 1 year perspective, from the 5 year perspective. So there would be a very good visibility for power equipment suppliers across the board. So that is something where we are positive. And another thing specifically from the T&D companies perspective is that currently, if we look at the other markets like US or Europe, they are also underinvested on the T&D side, and they are also, given the data center and AI-led boom, they are also trying to revamp their distribution network or transmission network. And some of these Indian companies actually can have an export opportunity in those areas. So again, uh, there is a good visibility for next 5 years, 10 years perspective. So entire capital goods space looks good, but manufacturing, defense, power, transmission and distribution, these are some of the areas where we have a much better visibility from next 5 years perspective. So we have to be slightly more selective on that particular place. Third area is consumption. I already talked about where income tax rate cut, social scheme, and then pay commission hike, which will lead. But it will lead to a higher growth in the discretionary consumption, not necessarily the FMCG. And that is where we are trying to position. We are positioning ourselves on the discretionary consumption side, not on the FMCG side. And the fourth area where we are very positive is on the platform businesses. These are new age businesses, essentially online app driven businesses. But Indian habits are changing, and newer generation is far more friendly to, or they are actually more inclined to use these services than what used to be the case with the previous generation. And the newer generation will become much and larger part of the population as we are moving forward. So and they are coming off at a very low market share of the overall economy. So whether we are looking at food delivery, whether we are looking at quick commerce, whether we are looking at a payment services, all of these are relatively small part of the overall thing. They are coming up from a very low base. So there is a significant scope for them to grow at a rate which is significantly faster than the overall market. Obviously, in some of these cases, the valuation are not conducive. We have to be cognizant of the valuation. And there has been a lot of opportunity which we don't participate because of the valuation concern. But still, there have been opportunities which are there where we can participate. And hence, we are, from at least from the growth perspective, we are very positive on this particular space. So these are the four themes where we are extremely positive from next 3 to 5 years perspective. And we believe that these are some of the themes which can actually contribute to the growth for us. And if you look at our portfolio across the board, we are essentially positioning ourselves in similar ways. So if we have a financial services fund which I manage. If you look at the benchmark for the financial services fund, the benchmark has a mix of 80-20. 80% is in the lending segment, which is essentially banks and NBFCs, and 20% is on the non-lending side, which is the asset management, insurance, fintech, payment companies, etc. So benchmark is highly skewed towards the lending segment. 80% weight is there on the lending side. If you look at a lot of those peer group, they have also created a portfolio which is aligned to benchmark in such a way. So even if you look at most of the peer portfolio which is there on the financial services side, BFSI side, they will have a very large weight on the lending side. When we launched this product about a year and a half back, we essentially look at the opportunities, and we found that there is a significantly better opportunity on the non-lending side. Definitely, it will move in cycle, so we need to be cognizant. But we thought that the 20% weight does not reflect the opportunity which is there in the market, and hence we have created a portfolio where we are significantly overweight on the non-lending space. So our Our portfolio has roughly currently mix of around 60-40. 60% is on the banking side and 40% is on the non-lending side. And we believe that this is one area which will continue to provide superior growth, and the banking space, banking weight or lending weight will provide the stability to your portfolio, and hence 60-40 probably do a much better justice to the opportunity compared to say 80 and 20. So that is how we have positioned our financial services fund. Infrastructure, again, trying to concentrate on these opportunities which is there on the manufacturing, on the power defense side, or on the power side. So these would be the three main bucket where you will find a significant positioning in our particular fund. Even in some of our business cycle fund, we are totally, we from next 3 to 5 years perspective, we believe that cyclical part of the market will do much better than the defensive part of the market, and hence our portfolio is totally skewed towards the cyclical segment. Again, sectors like financial, sectors like industrial, sectors like consumption, they form the majority part of the portfolio. And the fourth is our aggressive hybrid fund which I manage. Again, very similar positioning. Obviously, I have reasonable representation of healthcare. I have some representation of some of the other sectors, but we again have a significant position which is aligned to these 3 or 4 segments which is there in the market. And if you look at even our other portfolios also, you will see similar positioning where we are more aligned to these 3-4 segments compared to the rest of the space or the rest of the opportunity which is there in the market. So that is how we are positioning ourselves, and that is how we see the growth from next 12 months perspective also, and next from 3 to 5 years perspective. So I'll end over here. Happy to take any questions.